Welcome back to my Freetrade portfolio update. It's been a couple of months since I've managed to delve into this portfolio. And just as a quick reminder, maybe if you're new, this is a portfolio which is dedicated to using stocks from the FTSE 100 and pretty much getting into stocks which pay high dividends and we can reinvest over many, many years. So everything you see in this portfolio is based on the FTSE 100. Of course, if you are based elsewhere, you're very much welcome to buy these stocks as well. But everything here is focused on those UK dividends. Now, funny enough, we're almost approaching a whole year since this portfolio has been opened. I have done different little deposits along the way. And of course, every single dividend that's gone into the account, I have actually reinvested that and bought different shares along the way. And just before we jump into the portfolio itself, let's just give ourselves a little bit of an overview of what's been going on in the UK market over the past couple of months. Now, if we bring the chart of the FTSE 100 up on screen, you'll see that since the start of the year, it's actually down less than 5%, which when we compare it to the US market on the S&P 500, that's down more than 20%. It actually starts to look quite attractive, especially when you consider that the index has lots of global dividend paying companies. Now, there's a couple of reasons actually for this performance. Now, firstly, we'll look at the actual constituents of the FTSE 100 and the kind of companies that make it up. So as you can see, they're quite safe, pretty boring, and include kind of areas like financial services, pharmaceuticals, and consumer goods. So in the current climate with high inflation, rising interest rates. So in theory, these kind of companies should remain pretty safe because, of course, a lot of us rely on these companies and we're going to have to spend our money with these companies regardless of what happens in the economy. Now, another really key factor at the moment, of course, is the dreaded exchange rate. Our pound at the moment is extremely weak. Now, I was looking at the live charts earlier and we're sat about the lowest level we've ever seen for about 40 or so years. So things are not looking good. However, on the flip side, the FTSE 100 and this portfolio mainly is getting a lot of its profits outside of the pound. So in the short term, when those pound is low, when the exchange rate is poor and the pound is weak, we actually get more profits in from dollars. But of course, it is all swings and roundabouts. And as the pound hopefully improves and goes in one direction, we will see that change. But that does explain the kind of performance at the moment and why you might think, oh, the FTSE 100 looks like a great place to be. And the year-to-date performance, of course, looks very good when you compare it to the likes of the S&P 500. But it's kind of apples and oranges. You're not really comparing the same thing. And just before we jump into the portfolio, finally, let's just deal with a couple of little news pieces. Of course, we did have some big news for the economy this week. The Bank of England raising interest rates 50 basis points from 1.75%. Now, of course, that's not exactly a massive move up like we've seen over in the US with 0.75 and 75 basis points. But of course, from a UK perspective, that is the highest level we've seen interest rates since the great financial crash. At the moment, Andrew Bailey is pretty much between a rock and a hard place. We've got some pretty bad inflation and slow growth too. So he's trying to balance these things, keep everything calm and get the economy going and keep it going as well. Now, there's of course huge risk of recession for a long drawn out period of stagflation, which is when we have high inflation and low growth. And we're very much in a period at the moment where potentially we could be facing that. Anyway, challenging times ahead, especially for the new government who've just announced lots of new plans today. That might be a separate video. Let me know down below if you want a bit of a recap for that. But for now, let's get on the phone, let's get the portfolio up and let's see what the damage is. Right, okay, I'll put the portfall up on screen now as I'm looking it down on my phone. As you're speaking right now on Friday, as I record this, the FTSE 100 seems to be in a bit of a free fall. So we'll pretend that doesn't happen for now. Let me just head over, as I always do, to the Insights tab where we can actually look at performance. I do like to look at performance in the long term of this portfolio. If this is your first time viewing one of these portfolio updates, we can see that this portfolio has actually delivered pretty well against the benchmark of the VWRL, which is a very popular global ETF. Now, as one of you pointed out in the comment section, don't forget the VWRL also does pay a small dividend, but even at the moment, this has outperformed. So this current portfolio has done relatively well. That's not to say everything is completely in the green. Now, just let me go down to this Insights tab here as well, and just touching on what I mentioned earlier about the different constituents in the FTSE 100. We go into the sector, especially the sectors that I'm investing in at the moment. These fairly reflect what's in the FTSE 100. So as you can see, the top sector reflected here is actually finance, then food and drink, telecommunications, health, energy, consumer goods, utilities, mining, etc. Very, very different from the likes of the S&P 500, which is massively technology dominated, and of course pharmaceuticals and consumer goods, etc. And then of course from a position standpoint, it's fairly well diversified. When I started this portfolio, I wanted to have different stocks from different sections of the economy to diversify myself pretty well. And also every company you see in this list has had a very, very strong record of paying high dividends and growing for a very long amount of time. So long may that live. That was the whole concept of the portfolio in the first place. Okay, just before we go into the movers and shakers and who's been going up and down over the past couple of months, let's have a quick look through the activity tab and we'll just see what dividends have been paid and what purchases I've been making into the account. So you will see the occasional free share into the account, which is quite nice. I just sell them pretty much instantly. You will see then a dividend from Vodafone at £6.85. This is a stock which has got quite a high yield at the moment. It's one of those companies that I'm pretty much sure they've got quite a big ton of debt on them at the moment, but they are growing. And actually, if you are a customer of theirs, every single year they are raising their prices a little bit above inflation. So the increase I got on my bill this year was quite high. So anyway, lots and lots of customers under contract, of course, lots of money coming in to pay out some dividends. I also then bought a little bit of Aviva, just nibbling away there to get some more shares in the big insurance giant. And then also, as you can see, next dividend up from National Grid, the providers and the guys who look after lots of the National Grid network in the electricity and the gas networks in the UK and a little bit over in the US as well. Again, this is never going to be something which is going to grow really, really quickly. But if you want stability and if you want something that's going to always generate you some good solid dividends, then something like this in the utility sector should do pretty well. Then you can also see a little bit of buying into Legal & General. Again, just drip feeding if I see any free shares there. And also a bit of Haleon too. So we'll touch on that in just a moment. So Unilever paid a dividend of £1.81. So that can go toward paying the heating this year. I do have Unilever in my Hargreaves Lansdowne account as well. Big staple, big provider of lots of consumer goods. Now, even if you're a complete newbie and you maybe never heard of Unilever, I'm almost certain that in your house right now, wherever you're watching, you're probably very close to Unilever product. And of course, that's everything from Ben & Jerry's, you've got Hellmann's, Flora, Domestos, and loads of other different brands. So you're probably very close to Unilever products wherever you are watching this right now. Now, again, as we scroll up, we'll just see a few more different purchases. See a bit of Haleon there at £17.23, which I will touch on in just a moment. And then just nibbling away at a few more Vodafone shares. Now, let's go and talk about some of the big winners and losers and some big changes in the account. We'll go and talk about Haleon first. So if you were paying attention a couple of months ago, you might remember that Haleon was a spin-off from GSK. So GSK effectively splitting their business up into two different sections. One now to be called Haleon, which instantly became a hit, or at least a hit in terms of the size on the FTSE 100. As you can see, if I just scroll down here, it's estimated to be a net market cap of £24 billion right now, which of course did get it into the FTSE 100 immediately. Now, for some reason, I've got no idea why in my app it says minus 68%. That is absolutely not true. For all the time I've had it, it's down 11%. So you can have a look there and you can see Haleon is now a real position in the account. I'll probably nibble away at both Haleon and GSK. Now, typically when companies spin off, they tend to do pretty well. And the fact that you can now add the two up and they tend to be more than the original company was worth combined. And a lot of investors do tend to like that because, of course, if you have a company which does lots of different things, investors tend to think, well, I only maybe want to invest in that side of the business. Similar to conversations and similar to things you might say about Amazon. Lots of commentators and lots of analysts say, well, I wish you'd split off the AWS business and the online retail business. If you did that, you'd probably see two companies worth probably more than the combined value of Amazon right now. But hey, could be a success story. Be very interested to see their first set of results and how the company starts to get on. Now let's have a look at the rest of the winners. So we can see BP, HSBC and National Grid are pretty much the ones in the green at the moment. Now, no surprise here from companies like BP, of course, in that oil sector, making a ton of money at the moment. Whether that's going to last forever is anyone's guess, but of course, I think we're going to have some high oil prices and high energy prices for definitely a few months to come and maybe much into the future too. So that one's been doing pretty good. Also, very well paying dividend stock as well. So you can see when I go into BP at the moment, up for the year, up 39%. It's probably one of the only sectors in the economy at the moment, if you've been invested in, that you've been doing pretty well because everything else is pretty much in the toilet. HSBC is one of the other large positions in terms of performance, doing pretty well. More of an internationally focused bank outside of the UK, but in theory with higher interest rates they should do a little bit better, of course, as a bank lending out to customers, to consumers and of course businesses. But then you do need a good environment, of course, for those customers, individuals and businesses to want to borrow. So you do need a kind of a balance there, but they've been doing so far so good in the account. And then finally, we did touch on National Grid just a moment ago. These guys doing relatively well. We can see here up 6.58% for the year. Unfortunately, they have had a bit of a horrible month, down 13%. But again, we need to take dividends into account. As we can see, if we just go on to the stock itself, we can see it pays a very healthy 4.96% dividend. So even if this kind of stayed flat, you're still getting nearly 5% there as a dividend yield. So if you were looking to kind of safetify and diversify your portfolio, I just made up a word there, safetify. I was trying to say diversify, but you get the idea. Companies like National Grid could be something for you. Remember, with all of these things, please do your own research. Don't just copy this. This is just a kind of a side portfolio of multiple portfolios that I have. And really, this one was just designed to have a little bit of a play with UK dividend stocks to kind of grow this over a very long period of time. Just on the subject of dividends, I think on average the account was around, it's probably somewhere between 4.5% to 5%. I think it might even be pushing just above that if we work out the actual averages. To put that into perspective, then the S&P 500 yield at the moment, their dividend yield, I think is under 2%. So this is kind of 2.5 to 3 times the kind of dividend yield that you would typically see in the S&P 500, which is heavily more focused on growth stocks. Who will perform best over the next few years? Nobody knows. Now, quickly, let's have a look at some of the weaker positions out there. So GSK probably looks the worst, but I don't think it's taken everything into consideration of the Haleon split. So the chart seems to be all over the place here. Of course, GSK would be worth less as a business when Haleon gets split out. That's just part of a spin-off. That was always going to happen. Outside of that, the biggest loser then would have to be Tesco. So clearly every little doesn't help at the moment. For the month, them, unfortunately, they're down 13.72%, having a very bad month indeed. I've got no doubt that probably there's lots of fears of Tesco, the largest supermarket in the UK, being able to actually grow its market share and keep customers there. Because, of course, as people have less money to spend in their pockets, interest rates rising, stagnant economy, I think people are going to maybe be heading to the discounters. And if I do shop at both Tesco and the discounters, and it's quite interesting to see Tesco do lots of price matching, which probably is going to be hurting a lot of their bottom line at the moment. So I'll be interested in seeing their next set of financial statements, which are out pretty soon, I think. So we might be able to cover that one next month. As usual, if you do want to get started investing anytime soon, I have all of my links for free shares and free brokers in the description below. Don't have Freetrade, unfortunately. They're not allowed to technically share their link, but you can join in for something like Trading 212, Stake, or even Lightyear, and you can fill your boots with as many stocks as you like. But as usual, stay safe out there and do your own research. Until next month, thanks so much for watching, guys. Drop me a like on the way out, and as usual, happy investing.